Gareth Soloway, President, CEO, and Chief Market Strategist from InTheMoneyStocks.com, joins us and offers up his opinion on precious metal short term price movements and his outlook for the US dollar from a technical analyst point of view on this week's episode of Metal Money. I'm your host, Patrick Vieira. Gareth, welcome to Metal Money. How are you doing?
Hey, I'm doing very, very well. Thank you so much for having me.
Glad to have you on. Let's jump right into it. Silver is once again trading above its 50-day moving average, and the last few times we've seen this, silver was hammered down. Short term, is this a trend we can almost expect to see when silver breaks above its 50-day moving average?
Yeah, it's interesting right now with silver because the moving average obviously does play a role in what's going on with silver, but I think there's some ancillary issues going on, which obviously you have to do with economic activity being partially an industrial metal, and then the hope for this return to growth, but then also offset by the kind of the concern that people may exit the metal if COVID goes away. So we've obviously seen a lot of interest over the last 6, 8, 9 months because of COVID, right? People piling in away from the dollar because of the massive stimuluses that have been going on. And then the Federal Reserve, we know, is continuing to print money. So the concern here, and there's this back and forth going between the fear that silver could come down versus, okay, well, we know that the government is printing money for unlimited amounts of time here, probably going forward, and that will ultimately drive prices of silver up. So for me, it's looking at the short term move while maintaining this longer term bullish view on silver. And I can go into it if you'd like. I'd love to show the chart and kind of give people a
Sure,
sense of what I'm seeing.
sure.
Wonderful. So what you can see here, and you guys should see my chart popping up here, is that silver currently had that big run up from March. So March we bottomed out and we've been climbing, climbing, climbing up on the daily chart here. And we pulled back recently pretty sharply, all the way down to about $22 per ounce. And then from that point on, you've been in this consolidation range. And that to me is that pull and push where you have some investors saying, okay, well, economic activity is going to drive silver up, so let's buy silver. And then you have others that are saying the COVID pandemic with the vaccines coming are going to push it down. And that's why you see this chopping back and forth of the price action. Ultimately, for me, I'm thinking that based on this is what we call a bear flag formation in the chart. You should see a little bit of a drop over the next 1 to 2 months, maybe into January. And I don't know if this will happen, but if you get to this $20 level on silver, I will begin buying with both hands. And this is a huge support on silver. Now, keep in mind, it may not. Ultimately, I am hugely bullish on the metals, on Bitcoin, on these other alternates to the US dollar. But for me, as a shorter term investor, I have to pay attention to these shorter term moves and buy them if they get there. So, to answer your question there, the 50 MA is definitely important, but I think there's other workings here that are going to whip it around in the near term.
The renewable energy sector has been doing quite well. Should investors look for silver to ride the wave of renewables, being that one, silver is used in such things as solar, and two, renewables up may potentially mean oil down, which gives the mining sectors a lower cost of production? How did you see the rise in renewables affecting the price action for gold and silver?
So absolutely. So when it comes to renewables, there's absolutely going to be an impact on silver demand over the course of the longer term. And we've seen it just coming on and on with the rise in electric vehicles, the lithium batteries, all this kind of stuff is driving the demand for silver as well as other things like lithium. And you're going to see that. I myself have solar panels on my roof. And speaking from experience, it's one of the coolest things to be energy independent, creating all of my own energy. So, yes, the answer is absolutely over the longer term, silver will see demand pick up in that respect. Now, there's going to be a little bit of a letdown. I think that there's certain areas of the economy that will lose a little bit of the demand for silver as certain areas fall back. But I think the long term point here is that renewables and solar energy, all this kind of thing is here to stay, and it's going to keep demand for silver going.
Okay, so far I've been asking about the price movement for silver, but the reality is where we are today, and that is both gold and silver have been somewhat sideways for a couple months now. Is it more probable for gold and silver to break higher or correct lower based on your research?
The technicals are pointing to short-term weakness, and that is and one thing to remember here is that investors are very emotional. So you may have this great long-term bull case for silver and gold like I do. Excuse me, but it doesn't mean in the near term you're not going to see some weakness. And I think just as people are starting to see, and we saw it today with the vaccine news that came out with Moderna, that there was a little initial drop in gold. And that's just people saying, okay, I'm going to take some of my safety money from gold and just move it back to the stock market. And that's just a normal emotional reaction. For longer term investors, you want to kind of ignore that and you want to look at the bigger picture of the metal, which is very, very bullish. But I do think, like I talked about on the silver chart prior, that you will see a drop short term going into January, and then I would look to be a buyer, a heavy buyer of the metals after that, because ultimately the bull case remains, the printing of money, all these other things we've discussed. I mean, that is going to take it off. In fact, if you're okay with it, I'd love to show gold charts and look at a 2-year price target that I have on gold, if that's
Sure.
okay with you.
Sure. Go ahead.
All right. So let me show my screen again here, and I'll take you guys through this. But this is one of the coolest technical pieces that you guys can kind of understand. It's what we call a measured move in my industry. And essentially, let me just even zoom in a little bit for you guys. This is a chart on gold going back to the early 2000s. You can see we hovered down around $260 an ounce back in the early 2000s. And then gold staged this dramatic move up where we moved up about $1,660 an ounce to the high in 2011 of $1,920. And that was a move again of $1,660. Now, the measured move tactic in calculating targets dictates that from whatever pullback you get, which in this case was a pullback to about the $1,200 level, you should be able to arrive at an upside target of that same $660 move in the next move up. So essentially, if you break this high of 1920, which we're fluttering around now, when all is said and done, if you take $1,660 and add it to this low price of $1,200, you arrive at a price target of $2,860. So that's my upturn or longer term bull case for gold here. And there's one more chart I want to show here, folks, is that this is another chart of gold, and just confirm if you could that you can see this new one. But basically, this is a chart that also uses a different type of measured move to isolate down a target. And the beautiful thing about this is that this target gives us almost the same exact price point as the previous calculation. And when you're a gold trader or a stock trader, what you look for is symmetry in the charts, which is the measured move. But then you also look for a scenario where you have multiple signals telling you the same general target. When you have that, it tells you that you have something specific and affirmative with a high percentage chance of being achieved. So let me just quickly go through this chart for you. So this is going back to the early 80s, late 70s, and we had that nice pop to $875 an ounce. After that, we went into a 30-year consolidation phase, right? And then really in the late 2008, 2007 period, we started to retest that 875 high. You can see we then pulled back, which is normal. You hit resistance, you pull back a little bit. And then what was amazing is we broke through, and in 2 years, we ran up to 1900 and that $20 approximate per ounce high on gold. That was a move of $1,045. So the same thing, basically this high to this high here, the 875 to the 1920, that's a difference of $1,045 an ounce. So the idea being is that if you take this high of 1920 and you break it, which again, we're on the verge of right now, the measured move high should be an addition of $1,045, giving you this $2,965 price target of gold in the near term. And again, when I say near term, it's the 2-year price target. Now, the key here is understanding a couple things. Number one, that's very close to the previous target that we just looked at. So that gives you something very firm to kind of look for in terms of a range on gold. Now, I say 2 years. The reason I get 2 years is because that's the time it took for this move from this breakout of 875 to arrive at $1,920. So the theory is that it should take the same amount of time to go up that same amount over the next 2 years. So really, I have a 2 year price target that's just shy of $3,000 an ounce from the current level. The other thing I'd just like to mention is if you notice what gold's done here in the short term, is it briefly broke above that high and has pulled back. Well, we always look at history for where that happened before. If you look right over here, that 875 high, look at what happened. It broke above 875 and then had this retrace back down a little ways before really having that next move up. So when I talk about this looking for a near-term pullback on gold and silver, that's kind of what I'm talking about. You're almost repeating this exact same formation, this exact same pullback right here, and you're doing it right here again. So in theory, we pull back here a little bit more, you start to buy the metals heavily, and in my opinion, based on these charts, you should see a perfect move up to about just shy of 3,000, 2,800 to 2,965 here as a target on gold. Really fascinating. The measured move, for those of you that don't know it, it's an amazing tactic to kind of understand.
Okay, so we're looking for another retracement, and then it's time to buy.
Yeah, and again, the retrace has already started. So don't let it, basically, we're looking for over $1,000 move up on gold. You don't want to necessarily nitpick for 20 bucks here or there. Maybe a little bit more downside and then at least start accumulating, because I do think that bigger run is on the horizon.
Being that precious metals are measured in US dollars, where do you expect the dollar to move? Is your technical analysis pointing to a stronger or a weaker dollar?
Short term, the technicals are pointing towards chop, which makes sense because we're so unsure about the potential of, when will we get this COVID vaccine? How much stimulus is going to come on the other side of it? How much is the Fed going to be involved? And there's kind of this back and forth right now, right? So you still have the Republicans and Democrats not agreeing on stimulus. So the market doesn't know that. And we know that printing of money generally leads to a weaker dollar. So that's kind of my outlook in the very short term. But based on the chart, there's a lot of significant moves to the downside coming. In fact, the DXY chart, I have a downside move after some consolidation into the new year. You could be headed as low as 84 over the next couple years on the DXY. So there is some significant downside there. But I think the important thing is to realize that that is kind of to be expected. If we're going to be in a government situation here in the US where the government is just printing money and paying down debt with more debt and more debt, and the Federal Reserve has said that they're willing to go to whatever method they need to print money to help the economy and help unemployment, it makes sense that down the line we have to pay for that in terms of a weaker dollar. And that's the bull case too. It makes a lot of sense because it vibes exactly with what I've been saying about gold, where yeah, maybe a little short-term weakness on gold, but then gold should take off. I've talked about Bitcoin a lot to a lot of people as well. Any basically alternative to the dollar, unfortunately, for those of us that live in the US, is going to be a pretty good place to be.
All right, Gareth Soloway, we appreciate the time you've given us, and we hope we can do this again soon.
I would love to. Thank you so much for having me.
There you go. The dollar looks to hit some headwinds while precious metals are looking at a retracement before a healthy move up. As always, let us know what you think in the comment section below, and remember to keep it liquid, keep it real. Thanks for watching, and I'll see you on the next episode of Metal Money.